If you are 65 or older, or you are approaching retirement, there are 5 important changes in financial developments you should be watching before 2027 because they could affect how much money you actually have available each month. And here's the part many retirees overlook. Your retirement income is not determined by Social Security alone. Your taxes, Medicare costs, retirement account withdrawals, inflation, and even the way you manage your savings can all influence how far your money goes. Some changes may put more money in your pocket, while others could increase expenses or require you to take action. So in this video, we are going to walk through 5 areas every American senior should understand before 2027, and most importantly, what you can do now to prepare. This video is for educational purposes only, because individual tax and retirement situations are different, and you should always verify your situation with the appropriate government agency or qualified financial professional. The first major area seniors need to watch is Social Security and the annual cost of living adjustment. Every year, Social Security benefits are adjusted based on inflation, and the size of that adjustment can affect millions of retirees. But there is an important point that often gets lost when people hear about a COLA increase. A higher monthly Social Security payment does not necessarily mean you will have more spending power. If your rent, groceries, insurance, utilities, prescription costs, and other expenses rise at the same time, your real purchasing power may not increase very much. This is why seniors should not simply look at the gross amount of their Social Security check. Instead, look at what actually remains after Medicare premiums, taxes, insurance, and your regular household expenses. As we move toward 2027, pay attention to official announcements regarding Social Security benefits and Medicare premiums, rather than relying on social media predictions or viral videos claiming a specific payment amount before it has been officially announced. The second change seniors need to watch is Medicare costs and how healthcare expenses can affect retirement income. Healthcare is one of the biggest expenses many retirees face, and even a relatively small increase in premiums or out-of-pocket costs can make a noticeable difference when you live on a fixed income. Medicare, Part B premiums, Part D costs, deductibles, coinsurance, and supplemental coverage can all affect the amount of money left after your retirement benefits arrive. Some seniors see a Social Security increase and assume they will automatically keep the entire increase, but deductions can change the final amount deposited into their bank account. This is why you should carefully review your Medicare information when new premium and coverage details become available. If you have Medicare and receive Social Security, do not look at these programs separately. Think of them as connected pieces of your monthly retirement budget. A change in healthcare costs can effectively reduce the amount of your Social Security increase that you actually feel in your wallet. The third major area is taxes on retirement income. This is especially important because many seniors assume that once they retire, their tax bill will automatically become very small. That is not always true. Depending on your total income, filing status, and other sources of money, part of your Social Security benefits may be taxable. Withdrawals from traditional IRAs and 401ks can also create taxable income. Pension income, interest, dividends, and other sources may contribute to your overall tax situation. This means that 2 seniors receiving the same Social Security benefit can potentially have very different amounts of spendable income depending on their overall financial picture. Before the end of the year, it can be useful to look at your total income rather than focusing only on your Social Security check. If you regularly take large withdrawals from retirement accounts, make sure you understand the potential tax consequences before making a major withdrawal. A withdrawal that looks helpful today can sometimes create an unexpected tax bill later. The fourth change seniors should be watching is retirement account withdrawal rules and required minimum distributions. If you have money in a traditional IRA or certain employer-sponsored retirement accounts, the government generally does not allow those funds to remain untaxed forever. At certain ages, required minimum distributions, commonly called RMDs, can become part of your financial planning. The rules surrounding retirement account withdrawals have changed in recent years, including changes made through federal retirement legislation, so seniors should not assume that the rules they remember from 10 or 15 years ago are still exactly the same. Your RMD can increase your taxable income, and that additional income can potentially affect other parts of your retirement finances. This is why approaching an RMD deadline without planning can be a costly mistake. If you are already required to take distributions, make sure you know your deadline and understand which accounts are involved. If you are approaching the age when RMD rules apply to you, this is a good time to start planning rather than waiting until the end of the year. And there is another reason this matters. A required distribution does not necessarily mean you have to spend the money. Depending on your circumstances, there may be different ways to handle the distribution after satisfying the applicable rules. Some retirees use the money for living expenses, while others may save or invest it in an appropriate taxable account after considering the tax consequences. The important thing is to avoid taking random withdrawals simply because you think you have to empty your retirement account. Required distributions and voluntary withdrawals are not the same thing. Understanding that difference can help you make more informed decisions. The fifth area seniors should watch before 2027 is inflation and the changing cost of everyday retirement expenses. Inflation does not disappear just because you retire. In fact, it can become more important because retirees often have less ability to increase their income. During your working years, you might respond to higher prices by working additional hours, asking for a raise, or changing jobs. In retirement, your income may be much more fixed. That means rising prices can gradually reduce the purchasing power of your savings. A retirement plan that looked comfortable several years ago may feel very different if groceries, utilities, housing, insurance, and healthcare become more expensive. This is why seniors should review their monthly budget before 2027 instead of simply hoping that their existing income will continue to cover everything. Start with the expenses you cannot easily eliminate, such as housing, healthcare, insurance, utilities, and food. Then look at discretionary spending. You may discover that a few small recurring expenses are taking more money than you realized. The goal is not to stop enjoying retirement. The goal is to make sure your spending matches your income and that your savings are being used intentionally. There's also one important warning that seniors should remember when planning for these changes. Do not make major financial decisions based solely on headlines. You may see videos or posts claiming that Social Security is being completely changed, that the IRS is automatically taking senior savings, that every bank account is going to be frozen, or that every retiree is suddenly going to lose a specific amount of money. Some of these claims may be exaggerated or completely misleading. Government programs do change, but the details matter. Before moving money, closing an account, changing your Social Security strategy, or making a large retirement withdrawal, verify the information through official sources and understand how the rule actually applies to you. Another important step is to review your beneficiary information. Your retirement accounts and certain financial accounts can have beneficiary designations that determine who receives those assets after your death. Life changes, such as marriage, divorce, remarriage, or the death of a beneficiary, can make old designations outdated. Your will and beneficiary designations can also serve different purposes, so do not assume that creating or updating one automatically updates the other. Taking a little time to review your financial documents can prevent unnecessary confusion for your family later. Seniors should also pay close attention to financial scams as we move closer to 2027. Scammers understand that retirees may have Social Security benefits, retirement savings, Medicare coverage, and home equity, making them attractive targets. A scammer may call pretending to be from a government agency, a bank, Medicare, or another trusted organization. They may tell you that your benefits are in danger, that your account is about to be closed, or that you must immediately send money to protect your savings. The pressure is intentional. When someone tells you that you must act immediately and asks for passwords, banking information, gift cards, cryptocurrency, or money transfers, stop and verify the claim independently. Use a trusted phone number or official website rather than the contact information provided by the person who contacted you. Now, let's bring everything together. If you are 65 or older, the 5 areas you should watch before 2027 are Social Security adjustments, Medicare and healthcare costs, taxes on retirement income, retirement account withdrawal rules, and inflation. None of these automatically means that you're going to lose money. In fact, understanding these areas can help you avoid unnecessary financial mistakes and potentially keep more of your retirement income available for the things that matter. The most important thing you can do right now is not panic. Instead, review your situation calmly. Look at your latest Social Security statement. Review your Medicare deductions and healthcare expenses. Look at your retirement account balances and understand whether RMD rules apply to you. Review your tax situation and estimate your annual income. Finally, compare your monthly spending with the income you actually receive. When you understand these 5 areas, you are in a much stronger position to make decisions before 2027 arrives. Remember, retirement is not just about how much money you have saved. It is about how effectively you manage that money over time. A retiree with a smaller savings balance, but a well-organized budget, controlled expenses, appropriate tax planning, and a clear understanding of benefits can sometimes be in a stronger position than someone with a larger balance who ignores these details. So before 2027, take one afternoon and give your retirement finances a complete checkup. Look at your income, your expenses, your taxes, your healthcare costs, your retirement accounts, and your financial documents. If something does not make sense, ask questions before making a major move. You worked for decades to build your financial security, and you deserve to understand what is happening to that money. And finally, remember this. The goal is not simply to receive a bigger retirement check. The goal is to make sure more of the money you receive actually works for you. By staying informed about Social Security, Medicare taxes, retirement withdrawals, and inflation, you can enter 2027 better prepared and with fewer unpleasant financial surprises. If you found this video helpful, subscribe for more straightforward retirement and Social Security information for American seniors, and share this video with someone who is 65 or older and may need to review these 5 areas before 2027.